You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Boot Camp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. If you trade options, you want to be smart about every decision. So why not choose the smartest platform for your trades? At public.com, you can view upcoming earnings dates directly in the options chain. You can queue and execute multiple orders simultaneously. Easily view contract performance over time. And if you have a question about any stock, you can ask Alpha, their AI for investors. But want to know the smartest part of trading options on Public? Earning rebates on every single contract traded. No other platform provides options trading rebates, and they reduce your trading costs to less than $0 per trade. So, make the smart move and switch to Public.com, the only options trading platform where you can earn rebates on every single contract traded. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody. That music means it is time once again to dance on the old OBC. Yes, it is time to roll out the old drill instructor proving ground because it is time for Options Boot Camp, the premier options educational program. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network upon which all of you folks are hopefully having a good time. Seems like a lot of you folks are doing just that. Remember, if you miss anything on this show, it's available on the network going back over a decade now. A lot of great shows on the network, period, for you folks to sink your teeth into. So make sure you're listening to the full network. If you're just listening to Boot Camp, man, you just the tip of the iceberg of the options goodness that awaits you. And if you want to go even deeper, you want to go below the surface, only one place to go. theoptionsinsider.com/pro is the place to go to learn more, get great pro Q&As. Another one coming up immediately after this show today. Got our buddy, the options guy himself, Mr. Overby, holding court, taking down all your questions about all things options. So if you got more Qs, you got crazy hardcore stuff, you want to go deep, then by all means, the pro Q&A sessions are for you. Options oddities every week as well. So you get not just one, but two shows coming at you every week. This week, we're actually doing two pro Q&As. So 3 shows coming at you this week. You get early access to a whole bunch of stuff like all the OIC stuff we did, giveaways, live streams, all sorts of fun. theoptionsinsider.com/pro is the place to go. Remember, however you listen, could be the pro, could be on all the full network. If you like what you hear, throw some likes, stars, comments. It all does help new people continue to discover the content. This week's 5-star review comes from Keimer. I believe that's how you pronounce that. They say, great options pod. Good for beginners and experts. I do believe they mean experts, but we'll forgive you, Keimer, because you've taken the time to write for us. Experts like hosts make the content fun. Well, thank you very much, Keimer, and everyone else who takes the time out there to rate and review. It does help at the end of the day. And we appreciate all you folks for doing just that. Do we appreciate the black-hatted one, though? I don't know. Let's find out. I am joined once again by Mr. Dan Passarelli from Market Taker Mentoring, what the cool kids call to Mr. P, welcome back to the show. Isn't it nice that our listeners say we make the content fun, sir?
Yeah, that is nice. I enjoy. I like that because it's kind of fun for me. I think it's fun for you. And hey, if our listeners are having fun, that's a gosh darn trifecta.
So how are you celebrating this grand national holiday known as Prime Day, Day 2? What gifts are you bestowing upon me for putting up with you for all these years, sir?
Oh, yeah, it's coming. Just keep checking your mailbox, Mark.
I have been checking it now for over a decade and nothing yet. So I'm hoping this year's Prime Day is the day.
Don't give up hope.
In the meantime, listeners, I will keep waiting as we head on into the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, let's get to it. Let's get down to business with your questions, our answers, also your answers as well. Let's pay off some of the questions of the week we put out to you recently out there. It's been quite the range of fun stuff going on out there. We talked to you guys back a few weeks ago here on the show when we said, hey, heading into a holiday week, let's have some fun. NVIDIA was trading around 124. We said end of the year, so expiration date December 31st. Would you rather buy an at-the-money put or an at-the-money call? 46.6% of you said the at-the-money call. 27.6% of you said you want to buy that put. And 25.9% said, you know what? I'm out. I'm just going to have a fun holiday week there. And you know what? None of those answers are wrong out there, unless, of course, unless you bought that call out there on NVIDIA. Not looking great today, but hey, the day is young out there. The session is young out there. We're a wee bit below the 124 handle right now. Most of that's selling off today. So, NVIDIA can go red. I think we're going to get back to that a little bit with one of your listener questions. Let's keep rolling here. Let's go out to... Oh, yeah, we also asked you the start of the summer. We said times are usually quiet. Realize vol is typically low. Which option strategies do you anticipate using the most during the traditionally quiet period until Labor Day? I say traditionally because, well, again, we'll get to that, I think, a little bit later in a listener question as well, but it has been a little bit surprising. But we said you want to go short premium, so short calls, puts, or verticals. You want to go long premium, long calls, puts, or verticals. You want to go a little bit funky, a little bit crazy with the calendars and diagonals, or you have other. It ended up being a weird result. I think, like I said, something gummed up the works on Twitter with the results here because I know there were some votes early on for long premium, and then by the end it said 0 for other and 0 for long call, which is weird. We never have zeros. And then 54.5% for going all short premium, and then 45.5% for calendars. I know we have some hardcores in our audience and some very advanced options folk, but I don't know if nearly half of the audience is slinging calendars going into the summer period. So bit of, I think, a technical hiccup there. Maybe we'll have to run that poll again, see what the real answers are for now. But I kind of figured most of you would be leaning on the dark side, and that was indeed the case. Last week, we asked you on the show, we said, hey, it's earnings season once again, pretty much kicked off in earnest last Friday. Our long-term average for earnings season volatility has been just skyrocketing. As you've been listening to the network for a long time, we crunch those numbers with our buddy Matt over there from ORATS, have been doing so for a long time. And in the depth of the pandemic, earnings vol in terms of what was being returned versus what was priced in was anemic. Nobody gave a crap about earnings volatility anymore. It got down to, I think, in the 75% range, something like that, low 80s, which 100% would be every name returned exactly as much as they're pricing into their straddle. So 75, 80%, they're really not delivering a lot of juice, a lot of bang for that buck at all. Buying premium was just a throwing money away. These days now, we have skyrocketed in the other direction. We're averaging, our long-term average now for all the data we've been crunching is up to 113%. That's the highest I've ever seen it. It was 109% last cycle, and that was the highest I'd ever seen it. So it keeps skyrocketing, which means buying vol in aggregate, doesn't mean every name is going to work out that way, obviously, but in aggregate, buying vol has been the winner chicken dinner, especially for most of this year so far. So 113%, that is lofty juice. So we asked you folks quite simply, are we on track for another explosive earnings season? Will this cycle beat our current long-term average, which is the record? So above 113% or below. And Dan, our audience coming in for a banger season, almost 77% saying yes, it is going to exceed our current long-term average of 113%. 23% saying no. So interesting stuff. Again, if any of that confuses you, check out our website. We have all the data there. Again, it's all free. We like you folks. We've been giving it to you for years. Just click on the Options, News, and Articles tab. It's all there going back years. All of the earnings data there. Dan, I know you crunch a lot of earnings vol over there. Does that surprise you that our audience is strapping in for another banger earnings season? Are you doing the same?
Actually, I wouldn't mind clarifying some of the data if you're able to. And I don't want to go down a deep rabbit hole on here just for time's sake.
Let's go deep, baby.
So this is the long-term average. So this means if I buy a straddle the day before earnings, the long-term average is I make 13%.
Basically, yeah. We price all the straddles. If they hit exactly what their straddle is pricing in, it's 100%. And if they deliver more, they outperform, then it is north of 100%. And we've seen individual seasons obviously get above 100. It has to be higher in order to drag our long-term average higher, obviously. But yeah, it's been just crazy to watch, especially the last 6 months to a year where it's really just, the worm has started to turn, sir. Have you noticed that?
Yeah, I have. And so what is the long-term average? Is that just running data since he started this, or is he just always take the last year?
Pretty much. It's since we started this, yes.
So if it used to be below 100%, it's if we just take the recent data, it's even decidedly above 113.
Now,
right?
I'll have to clarify exactly with Matt. They may cut off some of the longest term trailing stuff. They may clip it at maybe, I don't know, 4 or 5 years, somewhere in that range. I'll have to check with him to be certain. But it is at least 4+ years worth of data we're looking at, maybe 5, if not longer. So, yeah, it's a long time frame in terms of analysis out there. We've always said for years, there's no clear-cut answer. People always ask us, should I buy or sell premium going into an earnings announcement? The data is always 50-50. It's a coin flip. You shouldn't really do either. Stay away from it unless you have a real clear axe to grind. These days, it's been leaning pretty hard towards the buy-in side, which, again, is somewhat aberrant. I never say that. I never come in and say you should do something in earnings. And again, this is an aggregate, so individual names will perform differently. But yeah, it's been crazy to watch, Dan.
Yeah, that is really interesting, man. Yeah, that's really interesting.
Speaking of interesting, you know what's always interesting? Our listeners have been waiting for it. It is time, listeners, for the Market Taker Question of the Week.
And now, it's the moment you've been waiting for. It's time for the Market Taker Question of the Week.
All right, Mr. P, what you got for us in what some might call a Loggins-inspired question of the week, sir?
I have been getting some questions on the long-term average of the VIX, and are we in a low volatility regime or a high volatility regime? And it becomes a really interesting question. Some people will say that the long-term average of the VIX is 20. They used to say that anyway, and I don't imagine the numbers, the way that's calculated, would have changed that much. But I believe that those figures include those really, really big spikes every, 7 or 8 years where it shoots up to 60 for, a day or two and then comes back down. And so for me, I would eyeball the long-term average more at like 15%. But answering the question as to whether or not that puts us in a higher low regime. I mean, right now, as we're talking live here, the VIX is at 1455, so almost at what I'm calling the long-term average. We have to measure it in a couple of different ways. One is just looking at that VIX number, is it higher or lower than there, but also comparing it to historical volatility, which has been really, really low lately. And I think that I've observed that historical volatility tends to revert to the mean a bit as well. So maybe that's coming up a little bit. Maybe we're picking up a little bit more on volatility, especially if you're listening to this live today. It's not some sort of crazy day or anything like that, but we got a bigger move than we've seen recently. So that's just a little bit of a brain dump on all that.
You know, that's a good debate. We've had that many times on our Volatility Views show over the years, Dan. And you're right. A lot of people trot out that 20 number for VIX. I've heard it a ton. It seems like I hear it the most often from people who have an axe to grind, like the SIBO. And I usually hear it when VIX is hanging out at a low level like it is right now. And they'll come out and remind people, the long-term average is 20. I see it more as a marketing tool. They're trying to gin up some action in VIX, because otherwise who's trading VIX when it's hanging out at 11.75, 12 like it has been of late? They want to gin up saying, hey, this thing could instantly revert back to 20. You got to get in and get some calls while the getting is good. So I see that as more of a marketing tool. For me, I kind of fall more along the lines of what you're thinking, somewhere in the mid-teens range. And the actual number, you're right, is hotly debated. If you exclude some of those crazy spikes, it's a different number. And of course, but those spikes are what you're in it for, right? You want to get those spikes. So yeah, it's a contentious beast, but I tend to agree with you on that. I tend to fall more in the mid-teens, whereas maybe some others who have a vested interest, shall we say, like to really beat that 20 drum out there. Where do you fall, Liz? What do you think the long-term average of VIX is? I'm curious. Are you part of the 20 crowd? Are you accepting the dogma? Or are you like Dan and I? You're saying no. You're going to think for yourself. I'm curious. Hit us up. Let us know as we keep on rolling. Let's go out here. I like this handle. The Mouse. The Mouse wants to know. He says, I really enjoyed the episode last week about portfolio hedging. Well, thank you, Mr. or perhaps Mrs. The Mouse. Does the same analysis apply to names like NVIDIA and Tesla? Thanks so much. Yeah, Dan, on the show last week, we did kind of our real world analysis of what it cost you right now to hedge in broad indexes like SPY right now. So the numbers we're seeing out there right now, we've been saying for a while on this show, a lot of other shows, things are kind of cheap from a not even tail risk. You're not going catastrophe put risk. In our example, we didn't go out that far in SPY at all. And we went out to September and we went down, I think, about 5% out of the money, somewhere in that range, not even 10%. And you could buy those puts. I think at the time, SPY was at a new all-time high of 560. So you would maybe assume maybe some of those puts might have a little bit of juice because people are starting, every headline you see is when's it going to turn? And yet those puts were trading for about 3.25. So that was about half of 1%. Again, going out to September. So you're getting a few full months of protection with that. Again, you're not straight at the money. There's a 530 put we were buying, so you're giving up 30 handles in SPY. You got to be okay with that. So if you're okay giving up, maybe 5%, then that was a decent trade for you. You're still up size on the year. I haven't crunched the numbers yet. They have them right here for me. I haven't looked at them yet, but I'm going to go out on my limb and say, who was it? The Mouse. Yeah, it's not going to be the same in NVIDIA and Tesla. Obviously, those are single name stocks. They trade at a much higher volatility level than SPY is going to, for obvious reasons. Look at what NVIDIA has done over the last year. Look what Tesla has done just in the last month. It's up, 30-odd% more? Let's pull it up right now and to see exactly. I mean, it's given up some today. Both of them are, but it's up 33% in the past month, excuse me. So, yeah, you're not seeing SPY do that. So, of course, you're going to have higher vol levels. But you know what? Because we like you folks, and because you folks like real world data, we did crunch the numbers right now as of showtime. I should mention a caveat out there right now. It's kind of a weird day. We've been seeing these days for a little bit now where the small caps and Dow are rallying. Dow rallied 700 points yesterday. So that rotation seems to really be in. Meanwhile, they're coming for NASDAQ and S&P today. S&P is off 1.25%. NASDAQ off 2.5%. So they're coming for both of those. And that includes coming for NVIDIA and Tesla today. So this aggressive sell-off could be gumming up these put numbers. Just clarifying that for you, but we can only use the data we have in front of us right now, listeners. These are real-world examples, after all. So NVIDIA was at 117.61 when we crunched these numbers, off 8 3/4, or nearly 7%. So not a great day for NVIDIA, all things considered. We looked at out-of-the-money puts, so you're talking September, and around that same time frame, we're going 10% out of the money here, a little bit farther out of the money. That's a more kind of standard metric. And that would be around, obviously, 11, almost 12 points. So we went down 106, 107 puts in September, somewhere in that range. They're both pretty close to $6. I think $6.15 for the 107s, like 5 3/4 for the 106s, somewhere in that range. So in NVIDIA, it's going to cost you 5% to hedge your stock down 10% through September. So it's up to you whether you think that's cheap or not. The stock's off 7% today, so maybe you think that's a worthwhile thing. But just saying, obviously, that's substantially more than the 1/2 of 1% we were talking about for SPY, and that's in that similar time period. Again, that was closer. That was tighter protection. That was 5%. This is 10% out of the money. So it's costing you more for worse protection in NVIDIA, which, again, is what you would expect. Let's do the same analysis in Tesla. Tesla, when we crunched the show numbers right before showtime, 249, pretty much even, off $7.50, or about 3%. So giving up some of the insane upside it's had over the past month. Again, so 10% would be about $25. So looking at those 225 puts in September, they were $11.60 at $11.70. So you can buy those for $11.70. So that's pretty close to the same level. Not quite 5%, but about 4.6% for 10% out of the money protection. So you could see very clearly, the mouse, that it's going to cost you a lot more, as it should, as you would expect it to in these names. These are two of the hottest names on the planet right now. So they're moving 3 to 6, 7% a day. You're going to have to pay more for those puts. That's just the name of the game. It's up to you whether you think a 0.5% for 5% out of the money in SPY is a better do than 5% for 10% out of the money protection in both NVIDIA and Tesla. Dan, these numbers don't come as a surprise. They may surprise some of our listeners at how juicy they are. Today's sell-off probably gumming up the works a little bit out there, but what are your thoughts on comparing the hedging costs of SPY right now versus some of these other hot names?
Well, I mean, on the one hand, the hedging cost should theoretically always be a fair amount less on SPY because it's a basket, and that's just sort of how the math works out. If you have a basket of stocks, you have lower volatility than the individual components. It's actually rather simple math. Just Google it. There's a Wikipedia page that explains it all. So yeah, you're gonna find that for sure. But that's because, two things. So therefore, the volatility itself, which means historical or realized volatility, is going to be lower for a basket rather than a stock. But then consequently, the implied volatility will be as well. So like if you think about the fact that a stock has a beta, like a beta is sort of a different way of thinking about volatility, very different. And let's say a stock like, let's just, Tesla or NVIDIA. Geez, I wonder what the beta for NVIDIA is. It's got to be big. Say it's 3, which would mean it moves.
I don't know if you heard, but NVIDIA is the market now.
Yeah. Oh, yeah. Fair enough. Right. If it's 3, you'd be buying 3 S&P 500 puts to hedge it. And by the way, I don't recommend doing that. That's not just a perfect hedge. It's a pretty, there's some correlation issues there. But if you just look at it from an overly simplistic standpoint of beta, if a stock like NVIDIA has a beta of 3, that means you'd be buying 3 SPY puts or SPX puts. You got to match up the notional values too. So I guess probably SPY in this case. So, the cost would be 3 times as much. So, I don't know. I guess the point I'm trying to make is there's a lot of math and there's a lot of factors that end up getting involved there.
I just did a cursory search because that is a good question. What is the beta for the name that is the market now, right? And I just did a cursory search. I haven't validated any of these analytics out here. This is showing here, Yahoo Finance is showing a 5-year average of 1.68. This other site, analytics site, is showing a levered beta for 1 year of 1.95. That might sound closer to reality, just given what we've seen out there of late. Yeah, so these numbers are all over the place. It's kind of a fun question. I might have to dig into that a little bit more. And Barron's is saying 1 3/4, so not quite 3, but is somewhere in the 1.6 to 2 range, Dan. Which, again, given what we've seen out there, makes a heck of a lot of sense. Yeah, how many names north of 1 do we see with a beta, right? Not many.
Yeah.
So, yeah, NVIDIA very much in rarefied air. Speaking of which, just to clarify this, what Dan was saying, obviously the basket should be less volatile. Obviously, you can look at VIX and get a rough estimate of what SPY vol is. A SPY actual 30-day at-the-money volatility right now, as we're doing the show, 12.1%. NVIDIA, 51.3%. Tesla taking it up another notch, 62.3%. So that's another reason why these puts are just so juiced, on top of the fact that the skew is different, on top of the fact that those two of them are selling off aggressively right now, whereas SPY is selling off, but it's not having the bottom fall out from under it or anything. So intriguing stuff out there. Speaking of intriguing, see what else you folks have in store for us here. Let's go out to Elite, A-L-E-T-E. I'm going to go with Elite. They want to know, seems like the options markets are still holding up, even though it's the summertime. Is that surprising to you? Well, I guess it depends what you mean by holding up. In May, we had actually decent numbers. You're right. The volume was kind of surprising. We have the numbers in our hands for June now, obviously courtesy of our friends over there at OCC. And if you've been listening to this show or any of the other shows on the network for a while, it's been mostly up month after month, pretty much since the pandemic. March was the first month in a while where we saw a bit of a downturn. That was an aberration because the year before March of 2023 was obviously all that contagion madness. So that was a bit of a apples to tangerines kind of comparison. So you take that out of the equation, March probably would have been up year over year. But now we have the numbers for June, and guess what? June was down overall, listeners, 4.7%. So yet another down month year over year, which is kind of interesting. Haven't seen a lot of these, and all of a sudden we saw 2 so far this year. You have to go back and dig into the data for June of last year. Sometimes the devil is in the details with these numbers. There could have been more trading days last year. Some other events really could have driven the volume last year, but total options volume down 4.7%. Also, interestingly enough, some of the areas of the market that have really been carrying the options market on their back for the last couple of years, ETF options and index options in particular, taking a bit of a hit last month. Index options, everyone loves 0-day, right? Down 9.3% year over year last month, which is kind of surprising. ETF options down 14.3%. That's also surprising. Also surprising, equity options up 3.1%. If you looked at the numbers for last year, total on the year, equity options volume was flat to almost down. So equity options up, everything else kind of down. VIX futures volume up 7.4%. So it was very weird, mixed month out there. But I guess to answer your question, Elite, at least for June, the answer was no. Now, we've had some banger days in July so far, so we'll see if we can turn that around. But Dan, were you surprised that June coming in a little light, especially in some of these hot categories like the 0-day stuff?
Yeah, you know what? I kind of was. Summer is a little light anyway, but yeah, I was pretty surprised by that because I don't know, when the market, there's a lot of irony when you look at the market from an option trader standpoint. When the market's going up, it tends to attract more people into trading options, which kind of doesn't make any sense because you can make money trading options if the market goes up or down or sideways or volatile or whatever. It completely doesn't matter at all. But that is just kind of how it is. And if there's more people in trading options, I would think there's also more people trading stock, and trading options consequently leads to more stock being traded because market makers hedge. So it is a little bit surprising. I would think that, especially since the market's been kind of absurdly up, that we would see more volume. Yeah.
Yeah, so we'll see. We've had a couple of hot days in July so far. We had those crazy NVIDIA days when it was doing seemingly almost as much as the market volume. So we've had some crazy aberrations in July. Will all that add together to be enough to make July year over year? We shall see. Oh, we shall see. Again, a couple of hot days, but I thought June would come in a little bit better than it did. Again, I need to go back and dig into June of 2020. Let me see. Do they say it here? I don't think they do. Usually they'll show me the trading days as well, and that's a big consideration. Everyone forgets that, but there could have been a couple of more or less trading days in one of those as well, and that could also gum up the works a little bit. All right, let's go here. This is just a straightforward options question, Dan. Kind of refreshing. Comes from BLS 209. They want to know, Dan, when do you decide to roll your puts versus just get assigned on the stock? All right, Dan, you're out there. You're trading hot and heavy over there at MTM. You blast away at some puts, and now you're starting to get close to the strike in the stock. When do you pull the trigger? When do you roll? Or when do you let them just ride and take the stocks?
And I assume we're talking about short puts, right?
I would think, unless he's getting assigned somehow on long puts, and he's figured out a trick I have not figured out yet.
Right. So the operative word there is decide. When do you decide to roll your puts versus just get assigned on the stock? You decide that at the time you actually sell the puts. You have a plan for what you're going to do, and that plan is congruent with your objective. Do you want to buy the stock? Like some people, present company included, often when I sell a put very specifically because I want to get assigned. Now, that said, there are some times when I sell a put when I don't want to get assigned, and that's when I roll. So, I mean, to me, that part, like actually getting assigned or actually rolling, that action, that's already predetermined. You're just following along the plan that you made. So, yeah, if the question really is when do you decide to roll your puts versus get assigned on the stock, you decide that probably before you even sell the put, or at least right after.
Yeah, that's the key. They got to decide that right away. We've been talking a lot on our Options Oddity show, which again is exclusively for you pro folks, comes up at the end of every week. The Rock Lobster and I have been short some Portillo puts, the July 10 puts. We're coming up to it now. I said then I don't mind taking the stock. I still don't mind taking the stock. So the stock did rally a bit back up to the 10 strike today. I was kind of getting ready for shows. I think I kind of missed that. That would have been an opportunity to maybe buy back or kind of roll again out to another month. That would have been kind of good. But again, sometimes you get busy, you miss these things, listeners. So you should, if you want to roll, you need to really establish that ahead of time. If you want to get the stock, then just sell the put and you're good kind of either way. But you do need to make that decision ahead of time. Right now, I'm probably going to end up taking the stock in Portillo's. I don't mind it. And that was kind of said when we first did it at the outset. That's the real risk analysis you have to do when selling a put. We say it all the time. Sometimes people will say, I want to collect this yield. They don't think about whether they actually want the stock if it gets there. If you decide you don't mind having the stock when it gets there, then you're good. You've done your due diligence for God and country. All right, let's get a few more in here. Then we got Brian up on deck in a little bit. Let's go out here to, it's just a fun comment from Litm, Litm, whatever you want to say. They say they've been listening to your show for a while. Find it greatly informative. Well, thank you, Litm. Thank you, he says. Well, thank you back at you again. He says, I have to admit, most of my use case so far has been writing calls against my Ford and Rivian positions. Yeah, Ford one looking like a banger lately. I have to agree with you there. Not much else yet on the exotic or options only front. Sorry, but I've been learning a lot. Yeah, you have nothing to apologize for, Lidm. First off, if you're doing covered calls, you're doing what 80% of the rest of the market is doing anyway. What do you think a lot of these large funds and these big asset managers are doing? You think they're doing a lot of exotic iron condor ratio swaps? No. They're doing covered calls against their position. So you're doing what 90% of the world is doing out there. So you have nothing to apologize for. If you only use options to do covered calls, that's still a great use case. From there, you could easily graduate to the other side of that, which is what we were just talking about, using short puts to get long the position. Guess what? Now you've graduated to the wheel. You don't even know it. You sell the put to get into the stock, you wheel out of it with the covered call. It's a great 1-2 experience. And if you just do that, I've said that a million times, if people just use options to get into and get out of stocks, you're already ahead of the game. You don't need to do all the other crazy stuff. All the other crazy stuff is just for fun. Just for giggles. But yeah, if you just use those two primary use cases, you're already ahead of the vast majority of people out there who are just slinging stock. Dan, what do you think to our friend here, Lidm, who's apologizing because all he's doing is covered calls, sir?
No, man. Yeah, just keep going with the things that are working for you. You know, get really good at doing this one thing. And it might be that that's all you ever do, and it ends up really working out great for you, and that's fine. If your interest change or the market changes, or you have a different need that requires a different use case, then by all means expand into it. But yeah, man, I love keeping it as simple as possible.
Since I mentioned the wheel, we'll get out of here on this one. This is from Diver SK, one of our longtime listeners. He's been keeping us apprised. We just talked about him last week, I believe, on his wheel strategy in AMC, and he was looking to expand it to some less meme type names like JP Morgan, I believe. He's writing in for what we said last week. He said, I heard on the podcast on the last OBC, so fun stuff. So he was excited to be on the show. He said, but note that I clearly mentioned cheating on the 70 delta part. Well, I did miss that. I have to go back. You've sent us a lot of data on your trades. I need to go back and refresh myself with how you're right. You did kind of play with the 70 delta a little bit. Maybe you need to send us a one paragraph refresher on your exact methodology, so I don't misstate you again. But you're right. You have been playing with that 70 delta. He said, I've also added in strangles to pick up the call skew and made extra when we had the pop to $12. Oh, there we go. So he definitely has been playing with Matt's 70 delta wheel strategy out there. In general, though, I try to follow the strategy. You know what, Diver? We need a little one paragraph summation of your personal tweaks to the 70 delta wheel strategy that Matt was talking about, whether you like them or not. And if they work, we'll share them with the folks. That's what we're all about here. Listeners helping listeners at the end of the day. So, Dan, Diver's doing well in his 70 delta strangles, or I should say 70 delta wheel, but he is playing with the 70 delta, and he's also adding strangles, which I got to go see what the strangle methodology is. What are your thoughts?
Yeah, that's interesting. To pick up the call skew. So he's selling strangles, I guess, right? Is that what I'm inferring here?
He says to pick up the call skew. So he's got to be selling one leg of that. Yeah, I would think. Yeah, you're not picking up this call skew by buying it in a meme stock. You know, you're selling it. So yeah. Yeah. I mean, that is very interesting. And that is a strategy. First of all, like a covered strangle is what I refer to that in my MTM Smart Income class, which is all on the wheel, which is selling that out of the money put and selling that out of the money call against shares of stock that you own. And what that does is you get double juice from that, because you can only get assigned on one of those two. And if you skate on both, you're just totally double dipping. But then also adding the 70 delta is pretty interesting too. Kind of changes it, because if you're selling the 70 delta, part of the problem with that though is that you're going to be net short units. You're going to be net short a call. And if the stock really takes off to the upside, you're in trouble. And that's if I'm understanding this correctly. The way I'm hearing this is you're long shares, you're short a 70 delta call, you're short a put, and you're short an out of the money call. That's what I think I'm hearing you say here, or reading you right. So yeah, I mean, you end up being short a unit there. Stock really takes off. You have unlimited risk, and you're getting margin quite a bit. I don't know.
Mark already asked you to write in and clarify one thing, so maybe clarify that too, and it'll make an interesting discussion for next time.
That it will. He's one of our longtime listeners. I don't think he's going to be going crazy net short units, but you never know. People sometimes get wild when they see those call skews in the meme stocks. I got to sell that. I understand the feeling. Mr. Dan, that music means we're coming to the end of another fun. I love when the listeners take the reins, Dan, because they just take us in all sorts of crazy directions, which is kind of the fun of the show. Do you agree?
Oh, yeah, I do. I'll tell you what, the Q&A shows that we have are my favorite ones.
They are pretty darn fun. And if folks want to have more darn fun with you specifically, Mr. Dan, outside of your appearances here on the old OBC, where should they go? What should they do?
Sure. Surf on over to markettaker.com, 2 T's in a row, and we're glad to help you any way we can.
There you go. Market Taker, 2 T's. Don't forget the second T for Theta out there. .com, the place to go to kick the tires and light the fires. While you're kicking tires and lighting fires, you need to go over to public.com. It's a great opportunity, not just for the rebate, which is certainly intriguing, but also you get a chance to really provide some meaningful feedback on a new options platform that is still evolving. So you can go there, kick the tires and light the fires, collect the rebate, which is always great, and then tell them, hey, I like this feature. I don't like this feature, or maybe I would like to see this, this, and this. They really want to hear that from you, because that's how they're going to build up the platform that you folks want. Public.com, the place to go. Tell them we sent you. They'll love to hear that. They're already loving the feedback. They've already renewed for a while on the show, so clearly they're loving hearing from you folks out there. But tell them you heard them on this show. That goes a long way towards keeping all these shows that have been flowing at you forever, keeping them coming down the road. That's going to do it for us on OBC. But if you're hanging out in the live, you're on the pro side, just take a chill pill for a few minutes. We'll be back in about 15 exactly with none other than the options guy himself, Mr. Brian Overby, a.k.a. the former host of OPR. Hope to get that show back again in some regular capacity. We'll see how we can make that happen. Brian is busy these days, holding down a number of hats over there. But he is coming in, nonetheless, to tackle all your deep, dark questions out there. See people hitting them up with inverse vol and all sorts of fun. Should be a good one. If you want to join that session, theoptionsinsider.com/pro is the place to go to get access. That'll also give you, once you click that button, access to every other pro Q&A we've ever done, every options oddities, all the other cool stuff. And, of course, get your name in the hat to win a pretty sweet, if I do say so myself, pro trading crate. Theoptionsinsider.com/pro. Back again tomorrow for our doubleheader of the option block and This Week in Futures Options. Friday, of course, vol views. Then back again for our pro folks, one final time for the week for options oddities. Then we're back again next week on the option block on Monday, followed by the crypto rundown Tuesday, pro Q&A for all of our pro friends. And we're back again next Education Wednesday, another episode of Options Boot Camp. Stay safe out there, everybody.
Check out public.com if you want to literally earn money to place options trades. There are no commissions or per contract fees. And Public gives you a rebate of up to 18 cents per contract traded. Discover why NerdWallet recently gave options trading on Public 5 out of 5 stars. And start paying less than $0 to trade options. Only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures and podcast description. U.S. members only. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.